What's up, everyone? It is your host, E-Money, your BFFF. Hey, I think a lot of people, when they're starting to make some money, always need a place to put it. Now, one of the most successful actions that we've ever done with our clients is opening up a wealth storage account and actually come up with a strategy of how you're going to allocate your profits to create more wealth for yourself in the future. One of the vehicles that we use to accumulate wealth is something called a cash value life insurance policy. Now, there is a right way and a wrong way to utilize these types of policies. And in this episode, we're going to go through the pros and the cons of leveraging your current assets to create more income, to create more wealth, to create more assets for yourself. We've seen people do it the right way. I've seen people do it the wrong way. So I think you'll enjoy this episode because we definitely tackle exactly how to do that. As always, if you guys need financial help, do not wait, do not pass go. Go to our website, econologicsfinancialadvisors.com. You can sign up for webinars. You can schedule a consultant call. You can take assessments. There's no excuse for not taking some action to improve your financial position, especially going into the next year. Okay. So do something about it. Be a best friend to yourself. Okay, guys, enjoy the episode. I'll see you on the next one.
I'm on a mission to help 200,000 practice owners achieve financial freedom. I'm Eric Miller, author of How to Become a Financial Beast. Download my free book today, A Practice Owner's Guide to Personal and Business Wealth You Never Thought Possible.
We are talking about the utilization of your investments. Actually, no, we're not going to talk about that. We're talking about friggin' life insurance right now.
Life insurance.
Yes, and the methods of accumulating wealth in life insurance. Okay, and God, I still am just baffled as to the amount of vitriol and the amount of stubbornness I see in this industry as to if you're not doing a whole life policy for wealth accumulation, anything else besides that, you're a criminal. Right?
Yeah.
And it amazes me. It really does. If you believe in the life insurance industry, do you not think that there's other methods that can be, done correctly to build, money inside of a cash value life insurance policy? Okay.
Yeah.
Everybody just needs to feels like they're going to be right about this. So I don't really care. But let's go back to what we're going to be talking about today. So I think a foundation of anyone's financial plan is that you got to have a system, especially if you own a business, of taking money out of the business and setting up a system where it's going to flow into certain kind of investments or accounts that are accessible to you, that are have earning potential to it, but basically are kind of like a storage place for money.
Yeah.
Right. For when you would for access to it. Okay. Now, in the system that we utilize, we typically have money transferred from a business account to a personal account. Okay. And from there, we have that money then directed into 3 different types of investment assets. And that could either be real estate, cash value life insurance, and or public securities. Correct?
Yep.
So we're going to be talking about the life insurance component of that because, we like to make sure people, and it's not always going to be just straight up cash value life insurance. It could be some kind of an annuity product as well, because some people may not qualify for cash value life insurance.
Yep.
So, but I think the primary reason why we have money or we utilize cash value life insurance and or annuities is for the guarantees is for the accessibility of the money. And
I would say accessibility, though, is only limited to the life insurance.
Accessibility is only limited to the life insurance. You're correct on that one. Yes, you're correct on that one. So, but let's talk about that. Let's talk about that accessibility and, some of the things, the things that we see, which are pros and cons to that. Now, the different types of cash value life insurance policies that you're going to use, we're definitely not going to get in that argument today.
No,
because that's where everyone's like, should I use whole life? What about index universal life? And, I've seen people on both sides of that aisle just go at it with each other about like, well, this one's terrible or that one's never going to perform. You know what I mean? It's just like, it's crazy. So let's just keep it as a cash value life insurance policy that you can maximum fund, that is designed correctly, okay, where you are putting money into it every single month or every quarter or every year, however, you're putting money into it, okay, that is growing a cash value component to it, right? Now, long term, most of the time, we're looking for that money to be then returned to you in some form or fashion as a retirement income stream, right? I mean, that's what we're trying to do for most of our clients. Yeah. And that money is usually guaranteed. It's going to be protected from any downsides or any investment losses or anything like that if it's in a properly structured type of cash value life insurance policy, not a variable, like, something that is pegged to either the dividends of what the company's paying or some kind of an index product.
Yeah.
Right. All right. Okay. So great. So now I have a system in which I am starting to create money in this cash value life insurance policy.
Yep.
All right. And just like any other investment that you guys have, something's going to come along that is going to entice you to want to take that money and put it into something else.
Yes.
Why? Because you guys just can't help yourself.
Because the grass is always greener on the other side.
Yes, it's true. It is.
It's
true.
not even. Yeah, I mean, I don't even know if I would say enticed to go into something else. Yes, that's part of it, but people are also enticed to just use it for life, whatever that may be.
Yes,
and there's correct ways to do that and incorrect ways.
Yeah. So why don't we get into that? So I set all that up because I wanted you guys to see like where this kind of product fits into your wealth building vehicles. It is certainly a stable place to put your business profits.
Yep.
To accumulate. We've had a lot of success. We've sold whole life policies before. And we've sold index universal life policies before. We tend to use the index for a number of reasons. I think primarily is because you guys think that the earning power is a little higher on those than we could on the whole life policies. And I think you guys like the fact that the premiums have some flexibility to them.
Yeah, I can earn more and it's more flexible. I mean, that's really the gist of it.
So, I mean, on the downside, someone could say, well, index strategies can not perform. And, there's an element of truth in there. But I think from what we've seen, at least on the real results, they've been better than just the dividend paying whole life ones have been.
Yes.
Now that may change as interest rates go up, but I mean, who knows? We'll see. But that being said, that's kind of immaterial to it because if it's not being funded, either one of them aren't being funded, they're not going to be any money there. You
got to put money in to build it up.
And
right?
if they're not designed correctly, which means that you are kind of minimizing the cash accumulation around the amount of death benefit that you have and just kind of like structured it correctly, it's not going to be a good result either. Okay.
Correct.
So you got to put money into it and you have to structure it correctly based upon, whatever the situation is. But then as money accumulates in there, we have a lot of people that are putting in $40, $50, $60, $80, $90, $100,000 a year into these kinds of policies.
Oh, yeah.
So money accumulates pretty quickly
Yes.
in these things. So then what have been some of the constructive things you've seen this money be used for?
Well, I mean, I think you got to back up first and say with these products, you're able to take a loan against your cash value, your investment value.
Let's talk
at
about
any
that.
point.
Let's talk about
You
that.
don't have to wait till you're 60 like you do with your 401k.
Yep.
You're just able to pull money out for whatever purpose, whenever, as long as it's in there.
Yeah.
And this is where.
So there's an accessibility there's accessibility to these types of products.
Yes.
Right. And that's usually done through a vehicle called a policy loan. And a policy loan is essentially where you have collateral with the insurance company, which is the cash value of your policy, right?
Yep.
And you say to them, Mr. Insurance Company, I would like to borrow $100,000. Okay. They're going to look at your policy. And if there is sufficient amount of collateral there, which has to be at minimum of, what would you say?
100,000.
Yeah. There'd have to be a minimum. I mean, there'd have like 90 something percent, I think, is what they're looking at. Somewhere around there. You can't borrow any more than what you have in your cash value. Let's just put it that way.
Exactly.
Like I can't say I want to borrow $500,000 and I only have $100,000 in my policy.
Yeah,
right?
You're going to be limited to There's
how much
different
how much cash
there,
yeah.
but let's just say 90% of cash value to be
90% of cash value. Okay, great. So you're basically saying I am going to. So the money stays in the policy. Like the money never when they say here is your 100,000. Okay. That money does not come out of your policy. Correct?
No, they're giving it to you out of their own checking account.
Yep.
And they're going to charge you interest because it's a loan. And that interest is going to be around 4%.
Yeah. No, I just did this with mine. You know what mine was?
What?
1.5.
Interest?
Yeah.
That's ridiculously
low. I know. It's 1.5% interest.
Wow.
So,
okay, but anyways, you have the 100,000 that you get from the insurance company. They charge you whatever they charge you.
Yep.
However, you still have all, say, 110 in your policy invested, earning interest.
Correct. Yeah.
So
you're just using an arbitrage at that point in time. So the loan really doesn't as long as you're earning interest in excess of what that loan cost you. Okay. Actually, yeah. Then it's basically a wash.
Yeah, and I mean, long term, these policies average about 6%. So, if you're paying 4% on a loan and you're earning 6%, you're actually still making money having a loan outstanding.
Yeah, yeah. Obviously, I don't want to do that like all the time, but here's the other part of that. What did you use the money for? Right?
Exactly.
Okay. So this is where we get into the problems of taking money out of your cash value life insurance policy, because it should be for something that's going to be worth the cost of not only borrowing, even though that could be basically a wash, but it could be for something. Well, I'll give you an example. I mean, one of my clients bought a business.
Yep.
Right. He bought a business a cash-based business that is probably going to, start earning him $200,000 or $300,000 a year, maybe in a year or so. Okay.
Yep.
Cost him, let's say $500,000. He took $500,000 out of his cash value life insurance policy for this.
Okay.
Okay. Was that a good use of that money?
Yeah.
Exactly. Right. Why?
Yeah.
Because I trust that he's going to use that $500,000. That's essentially not going to cost him anything out of pocket to then create, whatever that $500,000 is going to generate in cash from there.
Yep.
Okay. Now, I probably will have him start taking some of the profits to return the investment back. Okay.
Yeah. You go. Yeah.
Yeah. Would that make sense?
Yeah, I mean, you want to pay, even though you're borrowing money from yourself, in essence, you still want to pay it back, because otherwise you're not going to have access to the money again later down the road.
Exactly. So I want to return the investment from the person that sourced it, which was you, but it should, it should go back to, return of investment at some point in time. Now, that's a proper use of that, acquiring a business. Okay. What would be another constructive use of that money?
I mean, I've had people take out a loan from their life insurance to expand, remodel, new equipment, like invest in their business.
Yeah. Or buy a building.
Or, buy a building for their business.
Yeah.
But
so I've seen that too.
Yeah. Yeah. Those are good uses, because you're investing in yourself, in essence, right? You're spending this money so that the practice can make more money in the future.
Now, look, not only that, but you do not have to go to a bank to get the loan. You don't have to all of a sudden have a payment to pay the loan back, because there really is no payment schedule.
Yeah, it's like complete freedom. Pay whatever you want, whenever you want, however you want.
Yeah, to pay the money back. So there's not like an amortization schedule. You can create one if you want to, but there's no amortization schedule where the insurance company is saying you need to pay us back at this point. They're not going to do that. Okay, so it is on you to do that, and it's something that we would encourage you, that you certainly would want to do, but you're not required. Okay. But all we're trying to say is, like, you're using your own capital to go out and purchase an asset that's going to create more capital for you, essentially. Okay. That's a proper use of that. So buildings, expansion projects, real estate, that's going to be like really good real estate. What else? I mean, you could, obviously your own training. Those would be some things that you could do that are going to make you better or more valuable. I mean, I'd rather take it from somewhere else, but that could be something, as long as it's going to be something that's going to create more value for you at some point in time.
Yeah.
So, but that's not what we've been seeing lately. What have we been seeing lately?
I'll say in the last, 6 months, we have gotten more loan requests than I can remember in my entire time here.
Yeah, me too.
And it's a lot of requests just for working capital, or basically it comes down to people are taking money out because their business isn't making what it needs to.
Yeah.
Right.
That it would be a last resort. I mean, a real last resort.
Yes.
For something like that.
Yeah. Or, another example I had recently was someone who had to take a loan from their life insurance because they hadn't paid in enough taxes throughout the year.
Okay, there you go. So tax liabilities would be another one. There is definitely no return on investment from paying your tax liability.
No.
But the only benefit I can see there is that's going to keep you from going to jail.
Yeah.
But,
at the, you shouldn't, I mean, I guess in a perfect world, you shouldn't have to use your life insurance money or any of your investments to sustain the business.
Yeah. If you're having to do that, there is something incredibly wrong.
Yeah, exactly.
In your business that you are not confronting.
You're either spending too much or you're not producing enough, or a combination of the two.
There is something incredibly wrong.
Mm-hmm.
Okay. That is preventing that from occurring. Okay. So if you're having to dip into your investments to pay your taxes, if you're having to dip into your investments to salvage the business, then it's quite likely that you have someone in your organization that is working against you, or in your family that's working against you. That'd be the first place that I would probably look.
Yeah.
Okay. Because those two things should not ever have to happen at all.
No.
Where you're having to dip into investments to do that. But And it's really not just for the cash value life insurance policy, but because we've had some people that have had brokerage accounts that you can borrow from as well, although the rates are pretty high on that to do that. Yeah. But I think the best place. So, just to kind of reiterate, if you're going to borrow from your cash value life insurance policy, like what about buying a house?
I would take that. I'm not going to give that a blanket yes or no. I'm going to give that on a case by case, depending on their other debts. It's not a straight no, but it's not a straight yes either. I'm
a little bit reluctant to do that for most people, just because the house really isn't. You're never going to be able to pay that back, until the house is sold.
Well, I mean, yes and no. I mean, if you're in a good enough position where you have no debt and you just want to borrow from your life insurance to buy a house, you're probably profitable enough in the business to pay that back.
Oh, okay. Here'd be another one. What about buying a car?
I'd say that's kind of the same scenario.
It's the exact same scenario.
But it isn't, because a car is a depreciating asset where a home appreciates.
That's true. Yeah, you got a point there. I was just saying, like, if someone built up, let's say, $500,000 in their cash value life insurance, okay? And instead of going, so right now, if you go to buy a car, you're going to be paying 7% interest rates.
Yep.
Right. Whereas, like, in my case, the insurance company is only charging me 1.5% interest.
Yeah.
Right. So why not take the money out of my insurance policy, pay the car off, okay, and then just whatever payment I would have made to that for the car, just pay back the loan.
That's why I say this one is case by case. Yes, when you lay it out that way, of course, if you look at it in dollars and cents, it makes sense. But I would approve that for a client on a case to case basis based on, do I actually believe that they'll pay the life insurance off?
Correct.
Because if you get a car loan, right, and you don't pay it, they're going to come repo your car.
Yeah.
So you pay it. But if you take a life insurance loan and you don't pay it, nothing happens.
Yeah.
So most of the time I'll say yes to that, as long as the person is someone that is disciplined enough where I know they'll actually pay the loan back. I have no problem with that.
Yeah. Okay. That makes sense. So what do you love most about cash value life insurance policies then?
I like the accessibility, like we've talked about. You're not limited to like an IRA where you have to be 60. And I don't want to get too far off the beaten path, but there's some good guarantees that they have as well. So,
yeah,
but that's completely separate from this.
Not really, but okay.
Stuff like long-term care riders, right? That's valuable.
Yeah,
right?
There's just a lot of
older.
Yeah, there's just a lot of things that these policies have that that will help supplement other areas of your life. And all the talk of them being impractical or expensive or anything like that, we can show you the math. The amount of money that we make on those compared to, what we would make on a managed account is not really close over a period of time. So it's a product that needs to be utilized correctly. And if you are going to utilize it, for accessibility, just make sure that you're going to utilize it for something that's going to create more value for you or make your life easier in some way, shape, or form.
Yeah, it's a great tool if used properly.
Yeah, it really is a great tool. I've had plenty of people that have used it for, just a lot of different things that have been a benefit. But if you're struggling financially, that's like the last thing I'd want to do.
Yeah.
Is like start dipping into your life insurance policy to save your business, to cover payroll, to cover mortgage payments, to pay your taxes, for anything like that. That is not a very good use of that money.
Yeah, I agree.
For sure.
All right.
Anything else on that one?
No, I think that's it for now.
All right, buddy. All right, guys.
Till next
Until
time.
the next one.